What is up guys, Taiki here. Today I'll be going over the Humble Farmer Thesis. If you like the content, please like and subscribe and leave a comment in the comment section below so let's get started. So how did I come up with this, right? So essentially, as a humble yield farmer like myself, I always have to think about where to put my capital to work, right? Where do I deploy my capital to earn the highest yield with the safest risk? And so as I was thinking about this, I essentially built this mental model or a framework that assesses whether a particular ecosystem would have profitable yield farms in the short to mid term. This will make more sense as I explain throughout the video. But what does the Humble Farmer Thesis say? It says that a really good farming ecosystem requires two things. First, an AMM with lots of liquidity, right? High TVL, as well as a farm token to incentivize that liquidity. Second, a trusted and reliable money market. Okay, so before I get into, examples and explanations, a quick disclaimer. This thesis only looks at the current viability of these ecosystems, right, and the yield farms. Just because an ecosystem is not viable now, according to this thesis, doesn't mean that it can't be in the future. So keep that in mind. As always, this is not financial advice. So this will be the overview of the video. I'll go over 3 case studies of ETH-BSC Matic. I'll do a deeper dive on why this is the case, and then I'll evaluate Fantom using the Humble Farmer Thesis. So let's go over it in more detail. So obviously Ethereum last year, like roughly 12 months ago, there was this thing called DeFi Summer. It was like the first craze surrounding decentralized finance. So what kickstarted this and how was it so successful? Well, if you're aware, it was essentially kickstarted by the Compound liquidity mining program. Compound is a money market where you can lend and borrow assets. And I guess like when like Compound introduced its token, they essentially paid people to borrow and lend, and it's just like people just poured in a bunch of liquidity into DeFi, right? And then Uniswap was announced, right, along with SushiSwap and other yield farms. And I mean, this was like the obviously Uniswap is the largest AMM, has its highest TVL. It's the most highly valued DeFi token out there. Okay, next is Binance Smart Chain. So in early 2021, Binance Smart Chain just popped off, right? It surprised everyone and came out of nowhere with a scaling solution for DeFi by locking up tons of TVL, like with the likes of PancakeSwap and Venus, right? PancakeSwap being the AMM, right, the top AMM with a really good farm, and Venus being the top lending protocol. Yes, there was an exploit on Venus Finance in mid-May where $200 million was liquidated, right? $100 million in bad debt. Which it was an issue, and that's why there's not that much liquidity on Venus. However, I took the screenshot today. There's still over $2.5 billion of liquidity on Venus, and we all know how successful Binance Smart Chain has been, right? It might not be doing that well now, but it was successful, right? It was a really good farming environment. Lastly, Polygon, which I cover extensively on this channel. It was the latest DeFi boom that happened, which I covered on the channel, and yeah, you probably know what kickstarted it. Well, it essentially was kickstarted by these liquidity mining programs where Polygon did this DeFi for All fund, where they allocated $150 million worth of Matic tokens to, I guess, pay users to use, right? Use Polygon. The largest one being the Aave liquidity mining program, where we were all being paid to borrow and lend, which is amazing. We all made lots of money. This was a trusted money market. And then as well as QuickSwap, which is the largest DEX, and then the SushiSwap, and there's a bunch of other AMMs currently available, right? So in all these instances, there are a trusted money market, little iffy with Venus, but there's still a lot of money on there, as well as a bunch of AMMs that's trusted with a good farm token. So I guess a question that you might be asking is, how can I be so sure that the success of these ecosystems is the result of the Humble Farmer Thesis, right? There's 2 requirements. Well, let's dig deeper on why I think this is, and I guess I want to focus on the money market aspect, because any ecosystem can just fork Uniswap and create a good AMM, right? Like every ecosystem has some sort of decentralized exchange. However, I think the most important aspect of the Humble Farmer Thesis is the reliable and trusted money market, right? And yeah, let's just go over why I think that is. So let's just dig into Aave, which I think we're all familiar with. And if you've used Aave, you know how great it is, where you can deposit assets as collateral and earn interest, and you can use those assets as collateral to borrow against it, right? This was a screenshot taken a while ago, but you get the point. So money markets and like how important they are to every ecosystem is that it essentially allows you to leverage like majors like Bitcoin and ETH and other stablecoins as assets to be a liquidity source. It allows you to have flexibility. Because for example, like if you're like a crypto native and you own Bitcoin and you own ETH, right? I think like almost everyone owns those two majors. You might not want to sell those assets, right? Because of tax liabilities, you think it's going to go up. So it's really nice to be able to use those assets as collateral, borrow stable coins against it, and use those stable coins in any way, shape, or form, right? It offers a lot of flexibility because if I had to sell my Bitcoin to like play on Matic, like I might not do that just because I don't want to sell my Bitcoin due to tax implications. Also, money markets allow you to short an asset to hedge against potential market volatility, right? Because when you short an asset, you borrow something. So let's say you want to short ETH, you put collateral, you borrow ETH, right? On Aave, for example, you sell it immediately in the market for stable coins, hoping to buy it back lower, right? So you profit off of like whatever spread. Though most of us aren't really shorting assets, I argue that this is really important for, I guess, funds and like whales. So the reason I think this is so important is that a money market creates more sticky liquidity, right? Sticky TVL that boosts the entire TVL of the ecosystem. If you look at Polygon, the highest TVL, the protocol with the highest TVL is Aave, right? So the majority of the liquidity is on Aave, and a bunch of people are borrowing against their collateral and then deploying it elsewhere. And yeah, like I said, like retail investors, like we're probably not doing this. Like we're not like sophisticated enough to like hedge against all these bets. But you know, if you're managing hundreds of millions of dollars, it's nice to be able to short Matic, short ETH, short Bitcoin, because you know if a fund wanted to do that and there wasn't a money market, then you might have to move that liquidity elsewhere to do the same action, right? But if there's a money market, you can do it. It's like a central hub of liquidity, essentially. So, part 2 of the Humble Farmer Thesis states that yield farms follow TVL, not the other way around, right? With the bunch of other ecosystems, everyone's like, yo, can you check out this project, this yield farm on this blockchain, right? And you know, people get really excited about these farms, but if there's not a money market there, then I'm not interested because there's not that much liquidity. The reason for this is that developers, right? Because at the end of the day, it's the developers making these yield farms. Developers will chase the hot ball of money, meaning that more farms will be built where there's a money market with the highest TVL, right? Would you rather build a yield farm on Polygon with roughly $10 billion in TVL, or would you rather build a yield farm on some other ecosystem with like $100 million of TVL, right? Because if you're a developer, right? If you're a Wojak developer, this is how most people think, right? I mean, some like developers like want to change the world like with DeFi, but most developers they just want to make money at the end of the day when it comes to yield farms. And they think like, hey, I like money. I build where I have the highest chance of making money. And that is where there's a money market because that tends to have higher TVL. So hopefully that gives a good overview of the Humble Farmer Thesis. Now let's go over like a case study, I guess, of Fantom, right? And applying the Humble Farmer Thesis. So with any blockchain, there's always like a good AMM, right? It's not that difficult to create a good AMM. There's Spirit and Spooky Swap. However, there's not a trusted money market. So the Humble Farmer Thesis says it's not a good place to deploy capital for now, right? So as always, this doesn't mean I'm bearish Fantom. It just means that in the short to midterm, there's an opportunity cost of parking your capital on Fantom, just because there's not that much liquidity. There's not that much TVL in the entire ecosystem. I went over this thesis on my live stream on June 19th of like planning for Arbitrum, ETH Layer 2, and like Fantom. And I kind of explained like why I'm not deploying my capital, but let me reiterate. So this was roughly a month ago. And this was the screenshot from a month ago where Cream Finance, which was the only money market, right, has $13 million in TVL, right? It's not that much. And I got a couple angry comments saying like, oh, I love Cream. Like Cream is so cool. Like I love using Cream, right? And at the end of the day, it doesn't really matter what you think or what I think, right? I think Cream is good, but like there's not that much liquidity. I took this screenshot today and Cream has less than $7 million of liquidity. So liquidity is actually leaving the ecosystem. So, the market says that, Cream is not like a safe place to park capital, right? At least on Fantom. And the reason for this is because some time ago there was an exploit related to Cream Finance and Alpha Finance, where $37.5 million was lost. And I mean, you can argue that, you know, like Cream Finance, they fixed the code, like they weren't at fault, all that. But at the end of the day, if you study business, like marketing, PR, like branding, all that, people at the end of the day just remember this headline, right? Because when someone talks about like how bullish they are on Cream, for example, like I just remember, oh wait, they were involved in an exploit some time ago. And you know, as just because this is like a PR nightmare where like money markets have to be trusted and reliable. Like one exploit can just ruin the branding and ruin the image of the entire project. So, you know, until Fantom like either builds their own like money market or like has Aave or Compound build or like port their protocol to Fantom, I don't really see a way for Fantom to like grow in TVL, right? And because there's not that much TVL, there's roughly $250 million in TVL. Like if you're a developer, are you gonna build a farm on Fantom, or are you gonna build a Fantom on? Are you gonna build a farm on Polygon, right? It's more likely that developers will build more projects on Polygon, right? That's just what the Humble Farmer Thesis says. So yeah, I'm not interested yet, right? I could be in the future, but not yet. Yeah, like I mentioned, this doesn't mean that I'm bearish Fantom, right? I actually like what they're doing. It just means that there's an opportunity cost to being there given it lacks critical mass liquidity. And I mean, I'm sure I'll have comments like, oh, but I'm doing this farm on Fantom and it's so good. Well, I'm just saying there's an opportunity cost. Like I'm probably better off. Like the expected value of my capital is probably higher on Polygon than on Fantom. That's just what I'm saying. And also, like lastly, I mean, I was gonna talk about like this is the chart of the Fantom token, right? It's like it's done super well. It went from like 0.02 cents in 2020 to like it peaked at like roughly $1. So this doesn't mean that the token won't go up, right? For like Fantom, it just means that like as a humble yield farmer, like I have to think about like where to park my capital, and you know, there's many options on like where I can do that, but Fantom is not the place I'm gonna be parking my capital just because, you know, the Humble Farmer Thesis. So that's the end of the presentation. You know, hopefully this helps you determine where to put your capital from a yield farmer's perspective, right? This is a more, I guess, thoughtful way, a sophisticated way to think about it, because I always see these videos from like other YouTube and like crypto like influencers saying like, oh, this is the next 100x coin, and like, I mean, sure, Fantom is great, but like I see these videos of like Fantom like taking over the world like 1000x. I mean, like they have no logic behind it outside of like, oh, the tech is amazing. So hopefully this makes you like, this helps you make more educated decisions instead of like following random shills. So thank you guys for watching. Let me know what your thoughts are on the Humble Farmer Thesis. This is a thesis, right? So it's something that I think is playing out, but it might not play out. But we'll see. Like it'll take time. So, you know, hopefully this will give you, hopefully that like this is a better way to think about farms. So thank you guys for watching. Have a nice day and have fun farming.